Hello and welcome to the Harwood Report for August 20th, 2018, presented by Trade Academy. I am Keith Harwood, the founder of Trade Academy. As a reminder, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Take a moment to read through the rest of the disclosures, but just know that none of this is a trade recommendation. All right, so I always walk through the same sort of stuff, generally speaking. I'm going to look at the major equity indices, the VIX, what that's telling me. Where are bonds? What are they doing? Gold is a big story right now. I think it's being forgotten a little bit in what's been going on with the trade rhetoric. But, gold had gotten absolutely killed. And now seems to be setting up some interesting stuff for potentially a major reversal. So I'm going to talk a bit about that today with a real focus on what's going on in gold and how that kind of times in with what's going on with trade rhetoric, with Turkey, with China, with everybody here. So let's get straight to the information here. First off, the Fear and Greed Index. I've been talking about this for a while. I think the neutrality measure is probably about right. There is some fear here in the put and call options, but it's probably not as extreme as they're showing there. VIX is starting to get a little bit greedy instead of neutral. But this other stuff that's showing greed, stock price strength, the McKellen Summation Index, those things aren't, I don't think, particularly greedy. I think a lot of this is very neutral. So this 55 measure is probably about right. What does that mean? Okay, so when this number is at 55, it kind of means that the market doesn't necessarily have to pull back. It's not in a crazy overbought, over-exuberant status. When we see numbers in like the 80 range, then I get nervous that everybody is too bullish. That's what I'm looking at this for, is as an indicator of when everybody is either way too bullish or way too bearish. Right now, there are people on both sides of the fence. When I look at the S&Ps, there are people on both sides of the fence with the market about to break out to a new high. That is interesting. It is a setup for a potentially explosive upside move, especially with some macro news that could help trigger that. Remember, we're talking about how trade rhetoric is getting a little bit better with China. We're making some progress with Mexico and Canada. Generally, Turkey's the bad one right now. China has been the bad one. If that stuff starts to continues to improve just a little bit here, which I expect that the administration wants it to improve going into midterm elections, so they don't necessarily need it to improve today, but over the course of the next month, 2 months, 2.5 months, they're going to want to see the markets hitting new highs going into the elections. Just keep that in mind as we go through the longer term perspective. That doesn't mean we have to go to a new high next week. Generally speaking, we've seen these little pullbacks tended to occur at the end of months. This one right here was actually at the beginning of a month, so that was a little bit abnormal. That trend is starting to turn around instead. The run up in the first 2 weeks, a fall back for a week to two. A run up for 2 to 3 weeks, a fall back for only a week. A run up for a week, followed by a quick pullback in the beginning of the month because people generally expect August to be bad. I think that means that people got out early in August. May not have the selling pressure at the end of August that's going to come next week. I think that could mean that if we get above these highs here, which we're about to do, if we get above those highs, we could see explosive upside. And with that, I see the VIX incredibly cheap relative to where it was, 6 months ago, 7 months ago, but not incredibly cheap relative to where it was a week and a half ago. So when we were testing these highs before, the VIX was significantly lower. So what have we seen that means to me is that people have their hedges on when we're at the highs, and they're continuing to hedge at the highs. That actually sets us up to be a little bit more bullish, because it means that those that need to sell don't exist as in as much size. When we see a situation where the market's running higher and people are panic buying calls, that's a problem. When we're running higher and people are just using those rallies to buy puts, that creates potential for further upside. When I look at the VIX, the other thing I like to talk about here is the fact that over the last 6 months, the range is not as crazy. It's from 10 to 25. If I go out a year, we know that it's from about 9 to 45. We've seen the February event drop off the 6-month chart. That's important. It means that the range is tighter. And then in a month, we're going to see a lot of this stuff drop off, and then the range is basically from 10 to 20 and grinding lower. As the VIX drops, people put more money into the market, they get more confident, helps push it up. For us to see an event like February again really needs actually a lower VIX, not a higher VIX, because a lower VIX means nobody's hedged. Nobody's bothering to hedge. When the VIX is high, people are getting their hedges on. All right, so all of that said, if you want to know what kind of options trade I'm looking at, you got to sign up for the newsletter, and I'll give you guys the link at the end here, but it's probably, you can see it here on the site. You get 2 weeks for free. So just remember that as 1 week for free. So remember that as you're looking through this stuff. If you want to see how I actually can now take all of this options information to trade the S&Ps, you got to sign up and do it for free. That sounds nice. If I switch sectors here, let me talk about tech, because tech is the negative sector. There's a little bit of concern here, right? Tech is lagging because money is rotating from tech into industrials. When trade rhetoric gets better, industrials need money flow. So industrials are now showing a very actually constructive looking chart. If I looked at this back here, I'd say, gosh, industrials are terrible and the world is coming to an end. And that was just 2 months ago. Now we're getting constructive. We're not pressing the all-time highs here from January, which were 266, so call it about 4% away. But 4%, that takes, a month and a half to get there if we do it at a normal pace. So, stuff to keep in mind here. If that starts making new all-time highs along with every other sector, then we're kind of moving into 2017 mode. And then the question is, where are we in 2017? Are we in the end of year 2017? During the end of year 2018? Or are we pressing this sort of stuff where it's just getting too frothy and everybody's a little too exuberant? If it's happening with China trade deals actually getting better, I think we're just in the beginning stages of another big bull run that could last a couple months before a pullback again. Probably not quite as bad as February, though, because people still have a memory of that. People looking last 6 months don't have that memory, but people have multi-year memories in general overall. Okay, people still remember the subprime crisis and still use that as a measuring point, a measuring stick when they look at these markets and start thinking about what could happen if we had a really terrible situation. I'm not saying we're getting into that situation because I don't see that. Finally, small caps. Small caps have been just creating this major wedge. Is it going to break out? If so, this has got a huge run. And small caps are a high beta element, so if the market's going to run and small caps are going with it, this could be explosive. That's the one that's really got the big options P&L potential there. And I talk about how I like that one as well in the newsletter. So just take a look at that if you want to see how I trade a potential for an explosive move just before we're breaking out. On a breakout, it's a little different, to be clear. We'll swing it by bonds briefly, but I don't want to spend a lot of time on these because I don't see the story being that exciting. Every time we get up here towards 122, 123, we sit for a couple days and then drop back down towards 118, 117, whatever. So right now, I would guess that we're probably in sitting mode. The only interesting thing about TLT for me is how cheap the vol is. So if I go to TLT, here we go, and take a look at the vol. The vol in TLT has just been low here in the sub 9%. I mean, if I go out a year, TLT vol, it spikes up towards 12. It really doesn't get much cheaper than 9, though, historically. And so this 9% level potentially creates an opportunity if the market is looking for a way to hedge. Why would I hedge in equity volatility if I can get some leverage out of bond volatility? And those should also have big potential for macro movement. So if something really bad is happening, bond vol looks cheaper than equity vol. And they do end up trading, in terms of big moves happening in those two when something big happens. So we may have a big move in equities. If it's unwarranted, bonds don't necessarily move. If it's warranted, bonds should move. So if I'm really nervous about something, TLT vol gives me an interesting way to hedge it. Let's move to the precious metals. So I'll start with GLD and then I'm going to come back to GLD. So I want to just show you guys, we had that major liquidation over the last week and a half, 2 weeks. We've gotten to a point now where position sizing in gold is incredibly low overall. There's a lot of shorts, not a lot of longs. A lot of people have kind of given up. Okay, so everybody was worried that this trade rhetoric meant that just globally metals and commodity demand was going to be just destroyed. That's why we saw copper do what it did. Take a look at copper futures right here. That got crushed. And look at that recovery that's already starting to happen in copper. And it's not giving quite the same magnitude of recovery yet in gold because what's going to be the most used is copper. Gold just kind of got dragged down along with the base metals and the overall commodity selling, though, and with the dollar firmness. So when I look at the dollar, So you see that all this is related. The dollar's already starting to turn back around. Probably has a reason to kind of consolidate here around that 95 level if I'm looking at it in an index basis. The other one I like to really look at is dollar yen as a risk off, risk on metric, and that's getting hit a little bit more. And of course, dollar versus the yuan, because that's been the China news proxy. You see, there's a lot of stuff to look at here. And that's starting to maybe turn around here. It's below the 10-day moving average, so maybe that's a sign that this is going to start getting a bigger move. All of that stuff could create a really big bullish setup in gold. So remember, when the dollar index was at 95, gold was sitting closer to 116. That's a pretty good size move, if I can catch the timing on it right. If I have to go out long dated, I'm not going to get the money for that, because let me show you this again. In gold, vol's not necessarily cheap. There's ways to play it if I want to do a longer term trade. I'm looking for this as a potential for a squeeze setup. And so for a squeeze setup, I talk about how I'm going to do that again in the newsletter. But, if the squeeze doesn't happen this week, I wouldn't be surprised to see vol start to come down, and then I can actually look at this more as a structural trade, looking for that move back into the 120s if things with China get better. Because overall, commodities should start to get some money flow. Silver, of course, is very similar to gold. It had a bit bigger washout when it broke. It bounced back a little quicker, but it's actually lagging a little bit today. Silver, I think, should have been doing a little better given what copper's doing, but at the end of the day, I think there's just so much negativity in terms of people giving up and capitulating in the metal space that's causing a little bit of a lag in silver. Silver tends to perform best when everybody's really jubilant about the way the precious metals are going to perform. All right, speaking of commodities, I'm going to do the final stuff here and wrap this up, and that's oil. Oil obviously got hit as well. Things didn't look great for oil, and now it's starting to show a little bit of a bounce. So if that's starting to show a little bit of a bounce, it's not really a huge bounce yet, but it's starting to show a little bit of a bounce after that move here down basically to the upper end of this little consolidation area. Maybe we do a little bit of a chop like we did there for a week or two, and then another run. That would time really well with that first meeting with China, by the way, at the end of August. That could create the spark plug that gets oil right back to highs. That's like a 20% move. That's a pretty big potential in oil. XLE got hit when oil came back. And now it found support at the 200-day moving average and looks like it may want to go higher. OIH got slammed. See that got that back down to the March and April levels into the consolidation area. And now oil's starting to bounce, and this is starting to bounce too. And the big thing for me in oil is we see where GLD vol is, gold vol. Let's look at where oil vol is. USO, kind of near the lows. XLE, 16 is almost to the lows. OIH, 23 is almost to the lows here. So we're seeing really, really cheap volatility, really, really cheap optionality, really, really cheap leverage, really, really cheap defined risk in oil. With a directional bias, that can be explosive. Right now, if it's a weak directional bias, it's still explosive when structured right. So, if you want to know how I'm looking to structure that, sign up for the Harwood Report. You get a week for free. It's still stuck at $49 a month right now because I'm having some issues updating the price. So that's not going to last for long. I'm working on getting that fixed on a back-end issue. It's an operational issue. So you guys are the benefactors. You get it for $49 a month until I can fix it. And then as soon as I can fix it, I'm fixing it and I'm making it $97 a month. So if you want to get in for $49 for the lifetime of your membership, you get it now at $49 after your first week free. That gets you the newsletter that I already posted this morning. It gets you another video update on Wednesdays. So you get the free video that you're enjoying right now, the newsletter with more details, and then another video update on Wednesday that talks a bit more about trade structure as well. So if you like all of that information, you want to hear more, sign up at tradeacademy.co/Harwood Report. And feel free to email me, Keith at tradeacademy.co, or call me 312-600-8004 with questions or comments. Thanks again for everybody, and hope you have a wonderful trading day.